We're going to begin right now. So first of all, thank you everyone for coming on this Thursday evening. I know it's week 6 right now, and then next week is recess week, and you all still take your time to come. So thank you for coming. So my name is Cheryl, and this is my partner James. So I'll be presenting first, and then I'll pass on the time to James. Okay, so before I begin, let me do a short introduction of myself. So once again, I'm Gerald. So I'm a year 2 Biz Admin student. So one very interesting fact about myself is recently I just went for LASIK. So previously, my eyesight degree was around 800 plus. So after LASIK, my eyes are now clear to perfection. But then the drawback, right, is for 3 months after that LASIK operation, right, I have to wear like sunglasses. Yeah, so to avoid my eyes from being exposed to sunlight. So if you see me coming to school wearing sunglasses, it's not because I'm that cool, it's because I got to protect my eyes from the sunlight. Okay, so let's start. Okay, so there's this disclaimer slide. So anything that we tell you, any information that we provide to you when you do your own trade is up to your own discernment. So don't blame us if anything goes wrong. Okay, so this is the agenda for today. I'll be covering on the recap of basic candlestick patterns, support and resistance as well as trends, while James will cover the trend lines as well as application of concepts. Okay, so let's get into it. Okay, so just want to recap some basic terms which was covered last week. So what is the bull and the bears? So the bull attacks with his horns upwards, so you expect the price to go up. While the bears attack with his paws downwards, so you expect the price to go down. So this is for people who have never traded before and are new to trading. Okay, so on the right side there's LUSD. What is that? Okay, because when I first started out trading, I had a very hard time remembering what is long, what is short. Because long and short, it doesn't tell you which direction, right? So I came up with acronyms. So I use LUSD. So LU, long is up, short is down. So when you long, expect the price to go up. When you short, you expect the price to go down. It's very simple. LUSD. I hope it works for you. If not, you can come up with your own technique for remembering. So just to recap on last week's workshop. So what's a candlestick? Okay, we see 2 candlesticks right here. This is a bearish candlestick, bearish base. You expect the price to go down, right? So it opens above and it closes below. The bullish candlestick opens below and you expect the price to rise up. So it will close above. So we have the upper and the lower shadow. The upper shadow, the tip will be the highest price for the day. Or the lower shadow will be the tip of the lower shadow will be the lowest price for the day. So just going to do a quick recap. So for 6 I'm going to show you 6 candlestick patterns which was already talked about last week. So I'm going to go through it very fast. So this is a hammer. After a downtrend, you expect when you see a hammer, there will be a reversal of trend. So expect it to go back up again. So this actually suggests it's a bullish momentum. So this one I say LUSD, right? LU, so long, expect it to go up. So you long. So for the next one, shooting star is exact opposite of the hammer. Just like this time now, it's after an uptrend, so expect it to go back down. So go back down, LUSD, you want to short it, you expect to go down, right? So you short it. Then the doji is a candlestick pattern where the open and the close price is the same. So there's equal power between the buyer and the sellers. So when this kind of thing happens, when there's indecision in the market, you adopt a wait and see approach. Okay, then the next one, Marubozu pattern. So the Marubozu pattern is just a rectangle. There's no upper or lower shadow. So it's a very clear bullish indicator or very clear bearish indicator. So it's considered in your face kind of technical indicator. So I just want to share with you a very fast story. Because when I was in primary school, I lost my water bottle. So I went around asking everyone, where's my water bottle? So I asked a lot of my friends, None of them can tell me where's my water bottle until finally in the end, my friend told me it's around my neck. Yeah. So the thing is, yeah. So my previous friend, which I afterwards told me it's around my neck now. Only the last guy tell me it's around the neck. So yeah. So it's like in the face, but I didn't notice it. Okay. So next one, bullish engulfing pattern. So what does this mean? So the first candlestick is a bearish candle, a smaller bearish candle. It is accompanied by a very much bigger bullish candle. So it's around 2 to 3 times bigger than the previous one. That's why we say that the bullish candle engulfs the bearish candle. So this is a very, it's a good indicator of a bullish momentum. So what you do when it's bullish, you expect the price to go up. So LUSD, you long the currency. Okay, so bearish engulfing pattern works the same way. Basically, just as this one is the opposite. Smaller bullish candle, bigger bearish candle, you expect the price to go down. So you short it. Okay, next. Okay, so now go on to the main topic, one of the main topics for today, which is support and resistance. That is actually very easy. So how to remember, because I also cannot remember resistance. Now I can remember that. When I first started out trading, I cannot remember whether resistance is the top or resistance is the bottom. Because resistance could be bottom or top, right? So how I remember is RS. Okay, from top to bottom, RS. Or you can come up with your own terms, like RS is like random stuff. Or I used to play a game called RuneScape, right? So RuneScape. Yeah, but it's a lame game. I know all of you play this very good game right now, which is called Neopets. I know all of you expect me to say Pokemon Go, but okay. So, okay, let's go on. Okay, so these are the basic definitions of resistance and support. I know there's a lot of words. Let me break it down for you. So resistance is the price level where the selling pressure is thought to be strong enough to prevent the price from rising further. So let's say the price starts here. There's a lot of buyers. The price starts going up. So over here it says the resistance is the price level where the selling pressure is thought to be strong enough to prevent the price from rising further. So you go up, the selling pressure is strong enough, the price doesn't rise past the resistance. So it works the same way for the support. I would like to think of them like walls. So resistance and supports are like walls which cannot be breached. Okay, so you subscribe to the theory of resistance and support. By right, if you hit the wall, you will bounce back. You won't breach the wall. However, support and resistance, there are many other characteristics. So over here, I'm going to make sure how to draw the support and resistance lines, which is actually very easy. You just need at least, to draw a support, you just need at least 2 lowest lows. Okay, if you choose one, it's very risky because it might not be a very clear support line. You need at least 2 to draw the support line. Okay, over here there's a lot, so it's actually a very good support line. So it's 2 lowest lows. The lows are characterized by the lower shadow of the candlestick. Then for resistance, it works the same way, just that it's opposite. This time around is the highs. So you need at least 2 highs in order for you to draw the resistance lines. Okay, so it's actually very simple. Okay, so one characteristic is that support and resistance can actually break. So just like I told you earlier, right, support and resistance is like a wall. Whenever you hit the wall, you will bounce back. But over here, in actual fact, when you're trading in real life, support and resistance can actually break. So let's say if you're doing a trade right here, you draw a line, because I said earlier to draw a line you need at least 2, right? So you draw a line, there's a lot already, you draw a line. So expect it to rebound and go down again, but actually it broke through the resistance line, went up even more. You have made a losing trade if you have short it right here. So it formed a new resistance and support line. So one very important thing is resistance and support can actually break. Okay, next one, when resistance breaks through, when the price level breaks through resistance will actually turn into support. Okay, resistance turn into support, because support is the 2 lowest lows, okay? So, so actually this actually shows that it's like a double confirmation of this line. Traders like to trade along this line. So you have to take note of this line. Because once it breaks through this line, this resistance line actually turns into support. So where I put resistance turn support, right? It works the same way. Support can actually turn resistance. Okay, so very simple. Okay, I would like to suggest, because earlier I taught you how to draw the support and resistance lines. At least two, right? At least two lowest lows, at least two highest highs. I would like you to think of them as zones instead of like lines. Okay, what happens if you think of them as lines? The thing is, the actual fact is, sometimes the price might breach through support and it go back up again. So what happens if you think of it as lines? You saw that the price breaks through support and then you start to think to yourself, you start to panic, you start to close the trade. But if you think of it as a zone, you allow more leeway. So when it actually breaches through the line, you know that this is zone. So you won't actually close the trade so early. You allow more leeway for the price to go down. So in this case, the support line holds right here. Okay? So next one. Okay, so this is another concept, the strength of resistance and support. So resistance and support lines, they are different, but within themselves, they can be distinguished by the number of times it is actually failed to breach. So let's say the price failed to breach resistance, a lot of times we can count 5 to 7 times as compared to one whereby it only breaches 1 or 2 times. So I would say that for something with a major resistance line as compared to a minor resistance line, you have more confidence in the major resistance line. So similarly for the support, the more times it fails to breach the line, you will have more confidence in all these lines. Okay, so which is very simple. Okay, so next. Okay, so actually I reached the summary of support and resistance. It's actually very fast here. So just to summarize, what is support and resistance? Okay, thank you. Okay, so support and resistance. I talked about the definition of support and resistance. So it's like a wall which cannot be breached. Okay, it cannot be breached. And then I told you how to draw the support and resistance lines. You need at least 2 highest highs for the resistance and at least 2 lowest lows for the support. And then I also told you that support and resistance can actually break. So over here, it might not always rebound from the wall. It might actually break through resistance. And when the price level breaks through resistance, this resistance line will form a support line, and similarly support line can turn into a resistance line. And also, don't look at them as price levels, look at them as zones. So you allow more leeway for you to apply your respective stop losses and take profit. And lastly, also talk about the strength of the support and resistance. So the more times it breaches the resistance level, the stronger the resistance line is. Same for support. Okay, so that's it for support and resistance. It's actually quite simple. Okay, so now I'll go on to trends, which is even simpler. Okay, so basically a combination of support and resistance and trends will form the trend lines, which James will be talking about it later. So for trends, okay, so the trend is a very easy definition. The general direction in which the security or market is headed. So the price level might go up, go down, go up, go down. But the general direction is that it is going up. So actually, it's quite simple. Right? So the common knowledge is to follow the trend. Alright? So if you see an uptrend, what should you do? Should you long or should you short? So you should long, because LUSD, right? LU, you expect it to go up, so you long it. Okay? So there's 3 directions, 3 types of trends. The first one is uptrend. Uptrend is a series of higher highs and higher lows. So this price level reaches a high and it drops down and reaches a higher high as compared to the previous high. Same for the low. So there's an uptrend. Then for the downtrend, it's just the opposite. there's lower highs and lower lows. So this it reaches a low, the next one reaches a lower low, and same for the highs. Okay, then one less common one is the sideways trend, where there is a series of horizontal highs and lows. So it's horizontal. Actually, you can draw your resistance lines here, and you can draw your support lines right here. So actually, it's horizontal. You can long your currency here. You go up, you short it, you go down. So you draw the resistance and support lines. Then you can plan your trades accordingly. Okay, so actually there's nothing much to talk about. There's nothing more to talk about trends. But I just want to tell you my personal experience. Sometimes it may not be good to follow the trend. So if you all know, recently there was a very big trading event called the Brexit. Happened in June. So Brexit, what is Brexit? Basically it's the United Kingdom, the people of the United Kingdom voting whether or not to leave the United Kingdom. So the trend before the result came out, okay. So the trend before people went out of United Kingdom, before the people voted to leave out of United Kingdom, the trend is an uptrend. Everyone voted to remain. But what I did was I also followed the trend. So I placed a trade, I longed the thing. I followed the trend, but actually it was the wrong result. It was supposed to be opposite. It was supposed to be the opposite of the trend. So it actually went opposite. So the lesson here is you do not have to follow the trend all the time. While trend may tell you which direction to follow, there may be times where you ought to take a contrarian view, and with that you can take more profits from there. So just to add, there's a quote by me, quote by yours sincerely. Okay, that's not somebody else, but that's okay. I didn't come up with this quote, but I took it from somewhere and now it became mine. Okay, so trading capital is limited, but trading opportunities are infinite. So when you enter trading, when you do trading, there may be a lot of times when you panic, when you rush into bad decisions, and you end up making a bad trade which you regret. But the thing is, this mantra actually helps me because trading capital is limited. The amount of capital you have is limited, but opportunities are plenty. Opportunities are always infinite. So whenever I trade, I'll tell myself this, and as a result, I will stop entering into trades where it's like where it involves a bad decision. Okay, so yeah, that's all for me. Support resistance and trends. So I'll now pass on the time to James, who will then talk more about Trendline and apply the concept.
Okay, hi guys. Yeah. Okay, hi guys. You guys have made it to the second half of this direct session, so congratulations. I feel like a lot of you are like already know this because you guys know we're entertained. So I hope I can provide some insight. Yeah, so okay, let me just begin with a quick introduction. James, year 2, from the Global Macro Department. I'm in biomedical engineering. So like this is actually a lot more material that I'm used to writing. Like normally it's just short and first, but today's an exception. Okay, so at any time during or after this sharing, if you guys have any questions, then just go ahead. Okay, so Trendline. Okay, what are Trendlines? Trendlines are basically straight lines drawn through successive peaks or troughs. So okay, here I'll be using like peaks and troughs instead of highs and lows because like higher highs and lower lows sound a bit contradictory, right? So I'll be using peaks and troughs to represent highs and lows. So what does the trendline do? Basically, it negates the direction of the asset. So as long as you have an asset, right, as long as it can be charted out, and as long as the price movement can be tracked, you can draw a trendline. Yeah, so it just gives like a general direction of the price movement. It also gives areas of support resistance. Yeah. Okay, so what are trend lines used for? So basically, trend lines basically validate trends. So it basically gives a physical representation of trends because just now you saw on the chart, right? A lot of the trends can't actually be seen. So what trend lines do is they actually give you a physical representation. They actually give you like a line to look at to indicate where trend is going. So yeah, so they determine the validity of trend and they also indicate market changes. So when certain things happen to trends, like there'll be changes in the market and trend lines indicate those changes. Yeah. So of the things to look out for, you can look out for the steepness of the trend line. So the steepness of the trend line can be either super steep or super flat. Yeah. And then the other thing is how often the trend line gets penetrated. Yeah. Okay, so what's the trend line? Just like a trend, there are up trend lines and there are down trend lines. So an up trend line is basically a straight line going through successive lows. Yeah, so it's quite obvious from the price movement. 135 are the lows. So basically you just need to draw a straight line up and then you have an up trend line. Simple as that. Yeah, and then the down trend line is just the opposite. So basically you draw a straight line across successive T's. So then, in this case, 135 would be your peaks. You just draw a straight line down, then you have down trend line. Yeah. Okay. So when you look at the validity of trends, the first one is to look at how long it's been intact. So basically, if the trend has been within the trend line for a longer period of time, it's more valid. Yeah. So it's basically about the duration of the trend, how long the trend has been maintained. Okay, then the second thing is how many times it has been tested. So every time the price movement bounces off the trend line, it's like a test. So the more times it's been tested, the more valid the trend line is. Yeah, so for example this, like you see here, the trend line has been tested 3 times. If I was to have like a price movement that will go up and down like a few more times, then that trend will be more valid. Yeah. Okay. Okay, now is the steepness of the trend line. So basically, right, okay, a rule of thumb, like not strictly, but the major trend lines tend to approximate an average of 45 degrees. So like just nice, like a inclined plane kind of thing. But yeah, not all of them do, so it's just a basic rule of thumb. Yeah, because okay, if the trend line is too steep, then what tends to happen is that the price becomes unsustainable. Imagine the price movement going up a very rapid rate, right? It's very unsustainable. It's unrealistic for the price to keep increasing. So yeah, sooner or later it will fall out of the trend. Yeah. And if it's too flat, then it might not be a very trustworthy trend because for all you know the price movement might just be moving sideways. So you want a trend that's like a trend line that's like sort of just nice. You don't want it too steep, you don't want it too flat. Okay, and then we have trend line adjustment. So basically like a trend might be moving in a certain, the price might be moving in a certain trend, but then it sort of adjusts, like the steepness sort of adjusts. So okay, so in this example, right, if you look here on the left, the price is actually moving at a steeper rate. And then, because it's unsustainable, because the price cannot be sustained, it moves to the lower trend line here. Yeah, so this is actually the breaking of a steep trend line. So this is the initial steep one, and then now we have a more flat trend line. Okay, and then the opposite is also true. So we have the acceleration of a trend line. So basically what happens is, this is the initial trend line. The trend line is considered quite flat, but then because of market changes or fundamental changes in the underlying asset, what happens is that the price will accelerate a lot faster. So then you have the acceleration of the trend line. Yeah. So that's how you look at like the steepness of the trend. Okay, then the other thing you look at is trend line penetration. So basically, okay, the basic concept, right, is that a trend in motion tends to follow, the trend in motion tends to remain in motion. So like it's a certain inertia about it. So basically, if you spot a trend and you actually manage to see if it's up or down, then just follow it. The main rule of thumb is to actually follow the trend. Unless you think that there are like intrinsic changes that might affect the price, the main rule of thumb is to actually follow the trend. Yeah, so actually when trend lines are broken, it's actually quite a big signal. You should be quite aware when it actually changes. Because when it does, yeah, that should be your reaction. Like, what's up the street? Yeah. Yeah, so as you can see at this side, this is where the trend line is being registered. So then this is an indication of a change in trend from an uptrend to what could become a downtrend. Yeah. Okay, so in the penetration of the trend line, there are basically two scenarios. The first one is market adjustment. So, okay, so basically, right, if you look at this chart, okay, you can see that this is the initial trend line. And then this trend line is also being tested a few times. Like price actually tests this trend line like 3 or 4 times before it actually breaks through. And then it starts to follow this other trend line here. So then you can actually see that this is the flattening of the trend line. From a trend line that's initially quite steep to something that's more flat. So yeah, so basically how this can come about is that there could be certain views or certain fundamental changes that could affect the asset price. And then the market will adjust the price, the market sentiment will shift accordingly, and then you have a change in the trend line, a general direction of price. Okay, then the second thing, right, is basically intraday small market variation. So basically these are basically charts that are zoomed in. So like, as you can see here, this is actually an hourly chart. So basically these are actually charts that are zoomed in, and what you have is that you have market noise. So basically, even if a trend is following the trend line very religiously, right? You have market fluctuations and you have price fluctuations. So even if this is a gentle uptrend here, there will still be some form of like price fluctuation, which could sort of like test the trend line or could sort of like indicate that it could be a downtrend, but it's actually not actually telling the downtrend. Yeah. Okay, and then now I'm going to go to the application of the concept. Okay, so basically, before I begin, it's important to know that the exact mechanisms of the concepts aren't really that important. Like, these are just techniques that are developed. So what's important is that you understand like the fundamentals of how these techniques were developed and why people actually use them. So like, support resistance is important. Think about that when you look at these techniques, instead of looking at the technique itself. Because it can be quite complicated. So yeah. Okay, so basically we're going to go through 3 applications. We're going to go through the 1, 2, 3 trend change, the fair principle, and the channel line. Okay, so first we have a video.
This video describes how to detect a trend change in an upward price trend. I adapted the technique from Victor Sperandio's book, Trader Vic, Methods of a Wall Street Master. The following use weekly charts, but they can be on any scale, from intraday to monthly. To detect a trend change, begin with the rising price trend. Find the highest peak and the lowest valley before that peak. I show that as points A and B in the figure. If you draw a line connecting those 2 points, you get the following. Notice that price cuts through the trend line in multiple places, such as at C and D. We want to draw the trend line such that it begins from the lowest valley and approaches the highest peak, such that it does not cut through price. The next figure shows that I move the line down from point A until it no longer pierces price until after the highest peak. Notice that point 1 is after the peak, and it's the first place where price pierces the trend line. A trend line pierces the first signal of the trend change. The next signal occurs when price tests the high. I show that as point 2 in the following figure. Price has attempted to make a new high, but failed. Price makes a series of lower peaks, and that is another indication of a trend change. Point 2 shows that. The last signal of a trend change occurs when price closes below the valley between the highest peak and the test. I show that as a horizontal red line in the next figure. Price closes below the line at point 3. When those 3 signals happen, the trend has changed from up to down. Signal 1 is the piercing of the trend line. Signal 2 is a test of the recent peak. Signal 3 is when price closes below the valley found between the highest peak and the test of that peak. Thanks for watching.
Okay, sorry, the volume was a bit soft. I hope you guys can hear it. Okay, so basically, okay, I'll go through the concept later, so don't worry if you didn't catch it. Yeah, so basically this was developed by Victor Sperandio. Yeah, he actually has a book, so if you want to, you need to go check it out. Okay, so so this is the first thing we're going to go through. We're going to do the 1, 2, 3 trend chain. So basically, this is sort of a confirmation. So instead of just the normal thinking that once price penetrates the trend line, it indicates the trend chain, this is actually a more sure way of telling. Yeah, so okay, so let me get okay, so the first one, right, basically is the penetration of the trend line. So this is the first thing we need. So this is number 1, right? And as soon as it penetrates this trend line, right, it's gonna make a low, and then that low you're gonna draw like basically a support line. Okay. Then once it bounces off this support line, and it starts moving with the initial trend, which is an uptrend, you'll make a high. And where it makes a high, you can draw a level of resistance. Okay, and then soon enough, it is actually going to change. The trend is actually going to change. You'll actually go against the trend again. But this time, the price actually falls below the initial level of support that you drew at B. Then this is a confirmation of the trend change. Yeah. Okay, so it's like super confusing, but this is just know how to use levels of support resistance and how to use the trend to confirm that there's a trend change. Yeah. Okay, so this is an example. And you can see here, right, the initial trend line is actually an uptrend. It's actually an uptrend line. And basically, what happens here is that, okay, this is your 1. So basically, when it penetrates through the trend line, it's the first step you need to really get a trend change. Okay, then the second, okay, then as you can see, there's a successively lower trading days until it reaches your level of support. So as the price starts to reverse, right, that's where you should draw your level of support at D. Okay, and then once it hits the level of support, buying pressure will move the price up again. So then you have a trend that moves with the initial trend, and then it hits a level of resistance here. Okay, and at that resistance you draw your level, and at that point you draw your level of resistance. Yeah, and then if the trend were to really change, the price would incur some selling pressure, and then what happens is that the price will go below your initial level of support. And once that happens, there's a confirmation of trend change. Okay, so basically, right, if you want to break it down, it's just bouncing against walls, levels of support resistance. Then if it actually breaks through major support or major resistance, there's a trend change. Okay, and this is just an opposite example. So now we have a trend that's moving downwards. So you can see the trend line here is drawn on successive peaks going downwards. Yeah. And then what happens is that it penetrates the trend line here at 1. Okay? Once it penetrates at 1, okay, so now you have price momentum. You have momentum driving the price upwards. Now there's just momentum, right? So once momentum stops, it indicates there's a level of resistance. So this is your new level of resistance. So after it hits resistance, there's selling pressure. So then the price goes down again. So price will move down until it hits a level of support. And at that point, you draw a level of support. And then, after it's the level of support, it rebounds again, and it breaks through your initial level of resistance, then you have a trend change. Okay. Yeah. So that's basically the 1, 2, 3 trend change. You don't have to think too hard about it, it's just like a show way of telling that there's indeed a trend change. Okay, so the second thing that we're going to go through is called the FAIR principle. So the FAIR principle is also another form of trend change confirmation. And basically, it's a better indication of a trend change, but it takes a longer time to form. Yeah. Okay, so basically, right, the basics of it is that first you get your initial trend. You have a trend that's going upwards, and then you draw a trend line accordingly, fighting successive trough. So this is, and then at the point where it breaks this trend line or penetrates this trend line, this point is called this is 1.1. And then momentum will continue driving the price downwards until it hits a level of support. Once it hits the level of support, this is where you draw the second blade of your fan. So then this will be your second trend line. Okay? And then because of what Gerald covered just now about support becoming resistance and resistance becoming support, once price reaches those support and resistance, this now is no longer a level of support, but a level of resistance. So as the price moves up from this level of support to the level of resistance, if it incurs any pressure, price will go downwards again. But if it penetrates through this second trend line, or this new level of support, the point where the price changes, the point where the price inverses will be your new level of support. So just think of it as just like support resistance, support resistance, support resistance. Yeah. So then at this point here, you also support, and the price will reverse and eventually hit the level of resistance that was initially the price support. Yeah. And then if it actually breaks through this new level of support, the trend changes. So you can see this is just like a super long-winded way of confirming that your trend has changed. Yeah, so don't think about it too much. Yeah, so here's just another example. Like, this is the initial uptrend. You have the penetration through here. Then the price keeps going up to hit this level. Price reversal, so this is your new level of support. Draw your second blade. Price reverses. Hits your first blade, which is now a level of resistance. It bounces down, breaks through that level of support, and then eventually moves down to the third level of support before it reverses. And then upon hitting this level of resistance, the price moves down and through this third level of support, and that's how you know the trend is changing. Yeah, so 1 to 2. Okay, and this is just basically the curve. Nothing special, it's just the same thing. Downtrend, penetration of the downtrend, trend line, sorry. Then bouncing off new levels of resistance and support. We see, and once it penetrates this last blade of your fan, it's now an uptrend. So the trend is also. Okay, the final one. Okay, so basically now, okay, this one's a lot easier to understand, so don't worry. Okay, so basically now we have the channel. The channel is basically, channel is basically when prices sort of trend within two parallel trend lines. So think instead of one trend line now you have two parallel trend lines. So price moves within those two trend lines. Okay, so if you want to get really technical, one is called the base trend line and one is called the channel line. But to me it's two trend lines, same thing. Yeah, so now instead of this initial trend line that you usually draw, right, the up trend line is at 135, it's a successive draw. You just draw another trend line at 2 and 4 as successive peaks. So now what you have is trend lines that wrap around your price. So yeah, and the converse is true. For downtrends, what you used to do is you used to draw a downtrend line at 135 as successive peaks. So what you need to do now is just draw another trend line as successive draws. So it forms a channel, like you can see, right? Okay, so basically, when price moves within the channel, whenever price hits the base channel of the channel line, they give off 5 sell signals. So using your basic concepts of support and resistance, you can tell, right? If it hits the bottom trend line, it's a level of support. So now price is going to go up, right? So then this is the buy signal. Eventually, when price moves up and hits the channel line, the top trend line, this is your level of resistance. So now what you can expect the price to go down. So this is a sell signal. So yeah, sell signal, buy, sell, sell. Okay. Okay. Yeah, okay, so basically that's about it. You just remember that the markets are perfect and you actually have to practice. Like drawing trend lines is also actually hard. Like in the chart show, it may look painfully obvious what the trends are on the trend lines. It's more easy to look at charts like after they happen, after the price patterns have formed. But when they're actually forming, it's a lot more difficult to draw trend lines and things like that. Yeah. So on this website. There's good charts and there's good examples of Trendline. Yeah, okay, and basically what we mentioned today is we see more resistance, Trendline, and application of those Trendline. The exact mechanisms you don't really have to know, but basically how the support systems are applied to these concepts.